If you're still not paying attention to Bitcoin,
you are literally taking more risk right now not owning Bitcoin than having it.
Where does Bitcoin go from here?
It can go up between 300% and 500%.
We all remember the crypto hype of the past and the insanity that was on the internet. Yet if you look today,
well, Bitcoin has been plummeting.
The big problem with Bitcoin is it's not money and it's not really currency, and it has no actual value other than the fact that people believe it has value.
The value of cryptocurrency has been dropping dramatically.
So what happened to crypto? What lessons can we learn? And how do we avoid similar situations to the crypto hype bubble? In order to understand what happened, we first need to understand how cryptocurrencies work. Cryptocurrencies are effectively digital gold. There is no intrinsic value to it other than the respect that it has by investors. Naturally, gold, which operates on a similar premise, has been in use for thousands of years. You can pick it up, hold it, make rings, and is the neat thing of being shiny and rare. But crypto has only existed for a mere 14 years. To put that into perspective, crypto would not be able to drive a car, while gold would have been around before Caesar. Naturally, assets that are relatively unknown to standard investing principles are often more volatile than those that are not. Let's take a closer look at when stocks were invented to get a better idea of how to handle unknown assets. The Dutch East India Company was the first publicly traded stock in the world. Naturally, this idea of public companies was new. After all, most companies were granted sole rights by the king himself. To have this newfound way of interacting with a company made stocks a foreign idea. As you can see, the first two stocks, the Dutch East and West India Company, operated very differently to how normal stocks function today. However, over time, as you see other countries, namely the British and the Americans, implement stocks, you see it slowly evolve into the more recognizable stock graphs. Each time this happens, it evolves, grows, and changes. We can see this with other assets such as oil or gold when it was taken off the gold standard. Each time you see changes until it molds itself into the form we investors can recognize today. So why mention this with crypto? Well, crypto is far newer than oil, gold, and stock exchanges. Yet, if you compare the interest in the subjects, it contends with stocks, exchange markets, and other financial assets. The number of transactions is also insane. Stocks as a whole trade 8.1 million times per day, which some singular cryptocurrencies do by themselves. This insane use of something so new is a new phenomenon. After all, the first stock investment was limited to only the wealthy Dutch who lived in Amsterdam. Crypto, on the other hand, is accessible to everyone. That comes with its ups and its downs. The internet can allow for mob-driven mentality to emerge. Take, for example, the rapid speed at which trends occur. To use a personal example, I have been gluten-free my whole life. Rice cake sandwiches were my go-to in kindergarten. However, the emerging trend of gluten-free foods in the last decade has allowed me more expansive options, to the point that gluten-free food often tastes like regular food. You can throw fashion trends, music trends, and all other trends in this category. Crypto is no exception. Crypto, by extension, needs the internet to thrive. Sure, you can own a Bitcoin without the internet, but to trade and use it as a currency, one requires the use of the internet. This ability to thrive in an internet culture allows it to transcend barriers beyond local, regional, or even national markets. And all it takes is the perfect storm to set up mayhem. So what set up this perfect storm? Well, it's a combination of three things: high inflation, quarantine, and the GameStop event. Inflation refers to the phenomenon of substantial price increases. Naturally, during a period where there is a substantial percentage of the population could not work, Money had to be printed in order to supply them with enough cash to sustain themselves. However, in doing so, they unintentionally inflated the currency. Take, for example, the graph of prices. Notice how after the initial crash, it started very speedily rising. This was not caused by an increase in our economic output, but instead money print time. When inflation threatens the value of the dollar, people flock to assets that they believe will counter this inflation. This includes gold, stocks, and yes, cryptocurrencies. Early 2021, Elon Musk confirmed that he bought $1.5 billion in Tesla and was accepting it for purchases. This legitimized cryptocurrencies in the eyes of the masses, as in the first day, Bitcoin had risen $5,000, which was unprecedented for the currency. He did this to protect his cash against inflation, which is understandable given the circumstances. However, it still does not explain why everyone, not just Elon, was driven in this mass crypto frenzy. It's 2020 and quarantine has hit us. Since the no-word virus limited social gatherings, we saw a significant rise in the usage of the internet. This was the time where TikTok stars danced their way to the top. Twitch streamers and politicians played Among Us and tried to figure out who's a murderer.
No, because the doors, I was trying.
All the doors and then opened one of them.
And along the way, people got bored. After all, how many TikToks can you make? And how many Among Uses can you play? And if you're sitting at home, why not make some money while doing so? Now, the idea of finance content on the internet is not new. There are thousands of channels that make finance content, including me. Please subscribe and like while you're down there. With all this finance content, it can be pretty difficult to stand out. So what can help you stand out in the YouTube landscape? Well, anything that pulls on extreme emotions. Ever noticed how news articles talk about murders? This is because some of the most powerful emotions on the internet are fear, disgust, and anger. This not only plays into the internet culture, but into the finance culture as well. Many recessions are stoked by a fear of economic collapses. Additionally, many invest out of the fear of missing out, or FOMO. So to see Bitcoin rise from 9,000 to 13,000 to 20,000 to 30,000 caused a huge fear of missing out on this investment opportunity. Everybody secretly wishes to make a lot of money fast with no effort. It's why lottery tickets exist. However, Bitcoin offered up the promise of continual growth, constantly being reminded that it was the future of the world. If you did not believe it, you would regret it. Sound like something? Yes, the fear of missing out. Bitcoin was essentially a lottery that everyone could win, and that was a promise no one could turn down. But this does not explain how cryptocurrencies became mainstream. After all, there were many stocks that had just as insane of price rises during the same period. Why Bitcoin? Why Ethereum? Why Dogecoin? Why did anyone pay attention to internet finance influencers? Well, there's one thing missing. The GameStop short squeeze.
A group of users on Reddit decided to band together and to purchase call options on these specific stocks, especially GameStop and AMC, as you mentioned.
GameStop is an old model, and the stock was declining, and the business isn't growing.
They're doing is they are, quote, squeezing out the short sellers.
GameStop is set to continue their head-spinning ascent today. Shares are now up more than 60% pre-market.
The fundamentals of the company have been rough here.
It is true that my investment in that company multiplied in value many times. I also believe the current price of the shares demonstrates that I've been right about the company.
Why did this happen? Well, in short, no pun intended, hedge funds borrowed stocks to sell them in the market. They then promised to give these stocks back to the original owner. The catch was that the stock would be lower in value, meaning the hedge fund could sell it at the higher price and buy a stock at the lower price to give back to the lender, essentially profiting off of the fall of the stock. This had been done with the GameStop stock to such an extent that they were borrowing borrowed shares. essentially massively overextending themselves. Now, there is some inherent risk to these short positions. First, you must give back the stock to the lender in the future. This means that if the stock is written, you have to buy it at the expensive price to give to the lender for free. So what happens when enough Redditors buy into the stock in order for the price to rise?
This is not going to end well when it ends. And the bigger question is, when does it end?
When the big guys, including one of your main investors in your company, started to lose, you shut down the game to starve the little guy.
Being concerned about having enough capital to meet deposit requirements, isn't that a liquidity problem?
The hedge funds get squeezed. This was a monumental moment for the internet finance community. Finally had they won a war against hedge funds, with major ones such as Melvin Capital shutting down. There was some symbolic sense that this was the anti-2008, that instead of hedge funds screwing people over, the people screwed the hedge funds over.
A David versus Goliath story.
This bred an insanely fanatic finance community on the internet. Everyone was talking about GameStop. Everyone was talking about AMC. Everyone was saying their stocks are going to the moon. And what's the next revolutionary financial asset to shake up the game and take a stab at those in power? Cryptocurrency. With a singular Elon Musk tweet during a time when many were locked inside and on the internet and looking for a new investment opportunity, while the Wall Street Bets short squeeze had gotten everyone excited over this financial opportunity, the stars all aligned for cryptocurrency to take off. There were projections that crypto would hit $1 million, or that it would outright replace the US dollar. Stuff we would now consider foolish was taken as truth back then. Eventually, all hype-beast movements tend to die down, and with Bitcoin's violent scare with China threatening to ban the currency and Elon Musk's not 100% supportive words about it on SNL.
So you can trade for conventional money. Oh, so it's a hustle. Yeah, it's a hustle.
The price fell dramatically. The crypto hype was not done yet, with huge names such as Eminem and Snoop Dogg participating in NFTs, essentially blockchain property and commonly associated with cryptocurrencies. However, with all the drama surrounding crypto scams and the crypto fall, many grew to distrust the cryptosphere as a whole. As such, those who sunk their money into it during the hype phase pulled out. To the internet, it was just another trend that would rise and fall, with this one just so having the opportunity to help people make money. The whole hype crypto bubble of 2021 taught many investors valuable lessons. What happened? What can we learn from this? And how can we figure out where crypto will go next? Well, to answer the first one, the fear of missing out on this amazing opportunity, the greed of those investing to get rich fast, the anger at the thought of one being scammed, and the disgust in seeing new crypto scams and news being preached led many to distrust the system as a whole. Will crypto recover from this? Possibly. The asset is so new that we do not have a full understanding of how it functions. However, if it rises again, it probably won't be due to internet hype in the same way it was. Rather, it will be from the asset being truly valued. So take a lesson when you go investing. Don't try to rush money. Don't try to be greedy. Don't let your emotions get the best of you. Because at the end of the day, it's not about if Elon Musk thinks crypto will make you millions. It's about if you think crypto will make you millions. Thank you so much for watching. These videos take a long time to make, and if you could just consider liking, subbing, and commenting for the algorithm, it would really help me. Thank you.